Are you paying too much tax on your ETF's dividends? In this video, I will show you how to minimize the CRA's cut. Hold on to your seatbelts, folks. This is going to be a good one. Exchange-traded funds or ETFs are a great way to invest in the market. However, it is pretty darn important to understand their dividends tax implications, as that nugget of knowledge may just save you a whole bunch of money. We are going to look at how an ETF's dividends have different types of tax treatments, how to easily find their tax breakdown, and where to hold each type of ETF in your portfolio to maximize your after-tax returns. The goal for this video is to make sure you're not leaving money on the table. A single ETF invests in a basket of stocks, and as a result, the tax breakdown, well, it can have a little bit of complexity to it. For example, if we look at HYLD, the taxes for that dividend can be broken down into, well, here we go, eligible dividends, capital gains, foreign income, and return of capital. At first glance, this may appear to look like an aspirin sandwich, but let me assure you, it is fairly straightforward. And once you have a grasp of how it works, it can definitely help you pay less, taxes. So let's take a look at some of the different types of taxes we can find in each ETF, including those in the examples, as well as a few others as well. We will start with eligible Canadian dividends. These are dividends that are paid by Canadian corporations. They benefit from the dividend tax credit, which reduces the amount of tax you pay, but they do still add to your taxable income. So you got to keep that in mind. The next thing you may find is ineligible dividends. These dividends come from sources like income trusts or smaller corporations that do not qualify for the enhanced dividend tax credit. They are taxed at a higher rate compared to eligible dividends. You may also find interest income. This is income generated from fixed income securities held within the ETF, such as, well, bonds would be a great example of a fixed income security. It is taxed at your full marginal rate, meaning it's basically treated just like regular income. You can also have foreign dividends. These are dividends paid by foreign companies. They are not eligible for the Canadian dividend tax credit, which means they are taxed at your full marginal rate. When we look at a couple of examples here in a little bit, you will also see sometimes they will have the deduction in there as well, just to show what kind of withholding tax those foreign governments have taken as well. Okay, let's move on to capital gains. Capital gains occur when the value of an ETF's asset increases and are then realizes when that asset is sold. This will happen a fair amount with covered call ETFs. Only 50% of those capital gains are taxable, making them more tax efficient compared to other forms of income. Up next, we have return of capital. This is when an ETF returns part of your original investment to you. It is not taxed right away. But instead, what it does is it reduces your adjusted cost base, or that ACB, which I've talked about quite a bit. This means you may have higher capital gains when you eventually sell that ETF. Speaking of complicated, a sub to the channel is the exact opposite and a great way to show your support for future content. Knowing what sort of tax scenarios exist in an ETF is absolutely great, but how do we get that information? And maybe more importantly, how do we know how much of the dividend is of each type? Almost all dividends have a web page, and that is where we are going to find our tax data. Some ETFs make it quite easy to find, and there are some that are a little more tricky for sure. I think the best way to understand this is, well, let's go find us some tax documents. We will begin with the All Equity ETF XEQT. To start off, we will simply Google it to find their web page. Once we are there, a lot of ETFs will have a document section. So right here, as you can see, for XEQT, it is listed as literature. Once we navigate there, we do have to click on See All Documents to get to that tax info. The first thing you're going to notice is that this is previous year data. So in this case, 2023. And that is going to be the best we are going to get, as the current year data will not be available until early next year. So yes, this does mean that the data is not 100% accurate, but it is very, very, very close in most cases. it is definitely close enough to give you a good tax picture of this ETF. You will also notice that it does cover all of their ETFs, so you will have to scroll down to that XEQT section. You will also notice as well, they do give a breakdown for each dividend that is paid, but you really want to work with the cumulative total at the bottom. That's your most accurate picture for the whole year. Looking at this ETF, we have the following tax data for 2023. They paid out a total distribution of 57.740 cents. Of that, the eligible dividends were 19.557 cents. They had a return of capital of 2.25 cents, and their foreign income came in at 42.013 cents. They also paid withholding tax of 6.08 cents. As I said before, that foreign tax paid, that is withholding tax on foreign dividends. So when we calculate percentages, we will, in this case, add, since they gave it to us as a negative, this to the foreign income, which brings it down to 35.933 cents. Of course, let's convert those to percentages. So what we end up having is, for eligible dividends, 33.9%, return on capital, 3.9%, and foreign income, 62.2%. So looking at that dividend, we can tell that more than half of it is going to be taxed exactly like regular income because of that foreign income. And that absolutely should be a consideration. We're going to talk in a little bit, so you definitely want to stick around for that, on where you should be holding different types of tax treatments. In that very first example at the beginning of the video, we did look at HYLD. So let's take a look at them now. So in this case, when you go to the ETF, there's no document section. So this is one of those ones that is actually a little bit trickier. So with this one, you have to get to the tax information from the Our ETFs drop down. So in this case, our eligible dividends come in at 1.711 cents. That does work out to 1.1%. Capital gains are coming in at 10.372 cents, which is 6.9% of that dividend. Foreign income, that's coming in at 85.107 cents. And they've also got foreign tax withheld, so we have to subtract that from the foreign income. That's coming in at 11.005 cents. After removing the foreign tax withheld from the foreign income, we then end up with 49.4%. They also have return of capital. You'll see it's quite a bit, 63.915 cents, or 42.58%. Holy banana bread, that's a lot of return of capital. So their total distributions, by the way, it does add up to $1.50.1. So why is this information useful to know? Knowing how your dividends are going to be taxed can give you crucial information in where you may want to hold these ETFs to minimize those taxes. Some of you probably don't like all the math, and that's fine. But I will add that come tax time, your brokers are going to provide you with all the necessary tax slips for doing your taxes. So you don't have to work out all the math per se, as these slips will have already done that for you. We are only working this math out so you know where to hold these ETFs to make some of the numbers smaller on those tax slips. If you have ample room in your registered accounts, you should be using them to knock out these taxes. And as such, they will not be as important for you. If you are an investor that does hold some assets outside of your registered accounts, then these numbers are going to be very important for sure. As we talk about the best place to hold the different tax treatment types, it should be said once again that your registered accounts are the best place to hold all of these. But once your registered accounts are full, then you need to look at what type of dividends will do the least amount of tax damage if you are holding them in a non-registered account. This part is fairly straightforward. It's all about how much you are going to get taxed. Foreign dividends and interest income, you are looking at getting taxed at your marginal rate. So these ones you really, really want in your registered account. Capital gains does get taxed at 50%. So they are nice to have in a registered account. Though you can see you are paying less tax than you are on that foreign income. So that might be a consideration. Ineligible dividends, they do not get the same tax break as eligible ones, but they typically can range from 25 to 40% in taxes, depending on your province and your income bracket. They are definitely still nice to have in your registered account. Return of capital doesn't technically add to your tax bill unless you sell the ETF it was generated in. Nonetheless, It can also be a nice one to hold in a registered account. Now, Canadian eligible dividends, they do get the best deal as they are covered by the Canadian dividend tax credit, which can take their taxes down to as low as 7% up to a maximum of roughly 20%. Once again, that's going to depend on your province and, of course, your income bracket. If you have to hold dividends outside of a registered account, these are the ones you want to hold for sure. Of course, from the examples we looked at already, they have quite a mixed bag of tax treatments. And both of these ETFs are best in a registered account for sure. So what would be a good ETF for a non-registered account? If we just look from a few of the ones we've done in recent deep dives, VDY, they have 93.4% eligible dividends and 6.6% capital gains. XTIV, they have 95.6% eligible dividends and 4.4% return of capital. Both of these would be absolutely great ETFs to hold in a non-registered account. You are still paying taxes, but you're paying less taxes. That's what we're looking for with these ETFs and with proper placement. If you are interested in any of the stocks we used in this video as an example, please be sure to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on XDIV, and I will see you in the next video.